Why did the Bank of Canada drop the policy rate on September 17, 2025? When the Bank of Canada lowers its policy rate, it makes borrowing cheaper across the economy. Businesses can access loans at lower interest rates, reduce the cost of hiring new employees, starting projects, and investing in growth. Lower borrowing costs can also lower the break-even point on these investments, making them less risky and more attractive. This can boost GDP growth and reduce unemployment because companies are more likely to move forward with their plans instead of delaying them. When interest rates are high, businesses often pause hiring or expansion, loans become expensive, and a project needs to promise much higher profits to justify the high interest rates. Canada's GDP has been slowing, with Q2 2025 showing a minus 0.4% contraction. Given Canada's growing population, this negative growth signals real economic weakness. Output per person is actually shrinking. Ideally, GDP growth should stay in a Goldilocks range of 2 to 3%, not too hot, not too cold, to keep the economy healthy. Right now, we are well below that range. At the same time, unemployment has been climbing steadily since mid-2022, rising from 4.8% to 7.1% as of August 2025. Another sign the economy is stagnating too much. The Bank of Canada cut rates to encourage spending by both consumers and businesses, which should stimulate GDP growth and bring unemployment back down. The trade-off is that lower rates risk reigniting inflation. When rates are low, people and businesses are more motivated to borrow and spend, which pushes up demand. If supply stays the same, higher demand leads to rising prices, in other words, inflation. But with Canada's inflation rate back near 2% since August 2024, a major drop from the 8% peak of July 2022, the Bank of Canada saw room to support growth without immediately risking a significant rise in inflation. Even if inflation ticks up slightly, it will remain close to the 2% target. Why is 2% Bank of Canada's target rate? 2% inflation is not so high that it erodes purchasing power too much. At the same time, it is not so low that we risk deflation. Very low or negative inflation can cause consumers to delay purchases. Why buy today if it's cheaper tomorrow? This can completely stall the economy and raise unemployment.